The third stage is price inflation. And this is actually what central bankers and politicians desperately want to achieve. And from my point of view, there are some signs that now this third stage of inflation, price inflation, is now starting.
Hello there, my friends. Chris Marcus here with you for Arcadia Economics, and excited to have a new guest on the show for the first time, who is Ronnie Sto ferle of the Incrementum Asset Managers that I've been familiar with for about a year or two because it's nice. Ronnie also puts out the In Gold We Trust report. Also a fellow Austrian economist, actually from Austria, so that's near and dear to my heart. And with that said, it's a pleasure to welcome you on, Ronnie. How are you doing today, my friend?
Thanks a lot. Thanks for having me, Chris. Pleasure being here.
Yeah, well, it's a pleasure to catch up with you, especially here we are in September. I think it's still September of 2019. Fascinating things happening in the world. And perhaps to start, obviously, you're pretty in tune with the gold market, and maybe just give an overview of where you see things with trade wars, precious metals rallying, negative yielding debt, and all the other things that are going on.
So where should we start? There's so many topics to touch at the moment, so many factors affecting gold. But I think most important is my conclusion that I just see from price action that we're back in a bull market. And we have already been in a bull market in many currencies. For example, in euro terms, we're already trading at new all-time highs. The same goes for Canadian dollar, for Australian dollar, and actually for 40 other fiat currencies. But for some reason, people are watching only the dollar price of gold, while over here in Europe, I mean, we should follow the euro price of gold and the Swiss franc price of gold and so on, but still everybody's just following the dollar price of gold. And now gold in dollar terms finally broke out. We've seen that massive resistance zone at 1360, 1380, and once we went over this massive resistance, momentum kicked in. It was, I would say, managed futures, it was institutional players, it was wealth managers, also including some sort of FOMO, fear of missing out. And what is really fascinating is the fact that every dip is being bought. So there's an enormous amount of buying power on the sidelines, just waiting to enter this trade. And this is why gold just doesn't really correct in a meaningful way, which is a very, very strong sign. So from my point of view, we are clearly in a bull market. There are many factors driving that. Of course, it's central bank policy. We have seen this massive U-turn from the Federal Reserve. We are seeing that in the eurozone, it's very desperate measures that are being taken. Basically, QE to infinity. We're seeing that there's more and more polarization within the European Central Bank. I think, Christine Lagarde now taking office, she will even make Signora Draghi look like a hawk, because she's I mean, she's a lawyer, and at the IMF, you're basically responsible for restructuring bankrupt countries. So from my point of view, we are in a zero interest rate trap. That's, by the way, the title of our new book. It is obvious that recession risks are getting stronger and stronger. Our incrementum inflation signal has just moved to a full inflation signal. And I think that, what's really important is the factor that gold relative to equities has basically built the bottom and is building out relative strength. That's a very, very positive sign. So from price action, but also from the macro picture, I think it's an extremely good environment for gold at the moment.
Yeah, everything you said there makes a lot of sense. And actually, one of the things I've been hearing about over the past weeks and months, have the European Central Bank, have they actually started buying stocks yet? I know that's been a rumor that they've already purchased so many of the bonds that they're running out. Is that happened yet, or is that on track to still occur?
No, it hasn't happened yet, but of course we have seen that they basically completely ruined the bond market, not only for sovereign debt but also for corporate debt, especially for covered bonds. At some point, I think they will start buying equities. I mean, just have a look at the Bank of Japan. They're basically buying everything. So at some point, it's absolutely crystal clear that the ECB will start buying equities, that they will start buying REITs, whatever, and perhaps at some point, everything that's just available to buy, German lederhosen, whatever. It is just, it's pretty obvious that we're seeing this extreme decline in the marginal utility of new measures and of new debt. It is clear that central bankers now try to get fiscal policy in charge. The FT, for example, wrote about the last ECB meeting. The outgoing ECB president also announced that when his successor, Christine Lagarde, takes office, she will oversee a strategic review. This would have the scope to examine even more radical ideas, including the possibility of changing its inflation target and even the idea of the central bank paying money directly into individuals' bank accounts. So that's not from some, hardcore conspiracy gold bug side. It's from the Financial Times. So it is pretty clear that stuff like that is already negotiated. So QE for the people will come sooner or later. We're seeing the same discussions going on with MMT in the US. Somebody called it Mugabe Maduro theory or magical money tree. So, I mean, it's for me, it's pretty obvious that this is the next stage of inflationary policies.
It's incredible. It makes you wonder what von Mises or Rothbard would, if they could believe what was happening today. Again, as I mentioned earlier, you are an Austrian economist, and you mentioned in that great interview you did with James Anderson about the inflation, and as you mentioned, you just have a report out on that as well. I'll bet a question that a lot of people have is that given the QE, negative interest rates, and all the other insanity that's been going on, I think a lot of people realize that the government inflation numbers are, not really that in tune with reality yet. Still, I'm surprised we haven't seen higher consumer prices. And you mentioned how there's some of the Austrians look at the 3 stages of inflation. So maybe you could touch on that and maybe a little of what you shared in your report and put it in perspective.
Sure. Well, from the Austrian point of view, inflation is based on its original meaning from the Latin word inflare. It means an increase in the money supply, and this increase in the money supply is not neutral, and I think that's the big difference to the monetarists. It is clear that the first stage of this process is monetary inflation by central banks, but also by commercial banks. And I think it's wrong to only criticize central banks for inflationism, because the majority of the money supply is created by commercial banks, actually. But in 2008, of course, there was this massive confidence crisis and this drop in lending and collapse in trust within the banking system. So the central banks tried basically make up for that by creating enormous amounts of high-powered money or central bank money via QE. So this is the first stage. The next stage, based on Rothbard, is asset price inflation. So we have already seen in the last couple of years, not only in the stock market, but especially in the real estate market all over the world, in the bond market. I mean, we're seeing 17 trillion US dollars in bonds trading at negative yields. So at their all-time highs, but it's also in the art market and so on. We're in the midst of this everything bubble. And then according to Rothbard, the third stage is price inflation. And this is actually what central bankers and politicians desperately want to achieve. And from my point of view, there are some signs that now this third stage of inflation, price inflation, is now starting. So our proprietary incrementum inflation signal just switched to a full inflation signal. We've seen 50% inflation signal since December. This is when we started buying mining stocks, for example. We started buying commodities. Now, for 2 weeks now, we've got the full inflation signal, and we just sent out the publication, the interpretation of that. So first stage, monetary inflation, then asset price inflation. We have seen those two stages already. Third stage is price inflation. And actually, you know, the pain trade of these 17 trillion in negative yielding bonds, of course, is rising inflation. This is the pain trade for all those bondholders. And actually, nobody is really expecting rising inflation at the moment. We had this Bloomberg Business Week cover a couple of months ago saying the death of inflation. So yeah, I mean, I just can quote fellow Austrian Murray Rothbard saying, if you have the power to print money, you will do it, regardless of any ideologies or statements that you should limit your counterfeit operations to 3% a year, as the Friedmanites want to do. Basically, you print it. You find reasons for it. You save banks, you save people, whatever. There are a lot of reasons to print. I mean, that's just perfect.
Yeah, and when you think about how much these numbers put out, I'm guessing it's similar around the globe. You can correct me if not. I mean, obviously, the U.S. Bureau of Labor Statistic numbers say we have inflation of 1.5%. John Williams of Shadow Stats calculates it using the old formulas closer to 10. Which really skews. I mean, like you said, you have magazines saying the death of inflation when anyone who actually goes to the store, you know, I can find plenty of it. So if somebody needs some, you know, yeah. Although in response, as you mentioned, how people are looking for financial solutions, and I was flabbergasted when you mentioned how the fund managers you talk with, and you ask them how much exposure they have to commodities, and the answer is zero. Is that still the case? And any thoughts then on, would seem like anytime there's zero exposure to any asset class, at least worth further consideration of being long?
Well, commodities are probably, yeah, one of the most hated asset classes at the moment. From my point of view, there is some sort of a natural cycle where gold is most of the times leading. The next stage is silver. We have seen that silver was actually underperforming gold for quite a while. So the gold-silver ratio was above 90. Now we have seen this massive reversal. And the gold-silver ratio is a great indicator for future inflation, but also for the strength and the reliability of the bull market in gold. So if you see a falling gold-silver ratio, that's a great confirmation for the uptrend in gold. And now normally the next stage would be a bit later in the cycle, would be commodities and and energy, and actually over here in Europe, and I think Mrs. Thunberg has been to the United States just recently, delivering a great speech. I just can sense that if you're saying something positive about commodities, yeah, I mean you're basically the most hated person in a room, because everything should be green, everything should be sustainable, and so on. But actually, we need commodities for our industries, for yeah, our just our life, and for businesses. So I think this pendulum will start swinging soon again, but at the moment it's probably one of the most hated asset classes. There's no allocation in commodities by institutional players. This is going to change. We're seeing something similar with gold, of course. I think that mining stocks, for example, there's only 2 mining stocks in the S&P 500 at the moment, relative to the total market capitalization of the S&P 500. The mining space is very close to its all-time lows. So that shows you the amount of pessimism that we're seeing in this sector, which from a contrarian point of view makes me very, very positive.
Yeah, because like you point out, if everybody hates something and doesn't want to touch it, there's just some natural imbalance to the market, especially if it is something we need, which is the case with many of these commodities. You touched on silver a little bit, and it's certainly an interesting one. Silver, I believe, is the only metal below its 1980 high. And when you think about silver hitting $50, then, going back into the single digits, then hitting $50 again, then going back into the teens. Anything you can comment there? And what is the real story? It seems like a wild range of volatility over a couple of decades. And what do you see playing out in the silver market in particular?
Well, of course, I mean, silver is the little brother of the gold market. I don't know if you remember this movie, Twins, with Arnold Schwarzenegger, also from Austria, of course, and Danny DeVito. I don't want to say that silver is like Danny DeVito, but it's of course a much smaller market than the gold market, and this also means if there's investors' demand coming in, means that it moves the needle much faster than in the gold market, which is roughly 8 trillion at the moment. So from my point of view, we're starting to see investors really picking up silver stocks. We've seen great performance in some of the stocks that we really like in the silver space. We're seeing that the gold-silver ratio has rolled over. We're seeing in the ETF space increasing demand. So this is basically a consequence of the stage of the bull market. From my point of view, and this is according to the Dow theory, Charles Dow, the godfather of technical analysis, he said, in every trend, there's 3 different stages. First, there's the accumulation phase where you only, die-hard contrarians buy against a very negative sentiment and weak price action into the market, but the market is already kind of stabilizing internally. Then you've got the public participation phase. This is the longest phase and is basically the longest part of this party. And then you've got the distribution phase, the mania phase of every trend. And from my point of view, and we described that at length in our last In Gold We Trust report, we're at the beginning of this public participation phase. And normally within the cycle, I think that silver should become much more popular. So I think we should come back to gold silver ratio at around let's say 50, 55, perhaps even lower. And then, you can do the math. It's pretty easy. If we should arrive at my long-term forecast for gold, which is 2,300 US dollars, which is only the inflation adjusted all-time high, then, you can tell that silver has got a spectacular price performance ahead.
Yeah, I couldn't agree more with what you mentioned, especially about the accumulation phase and when the public gets in, because even back in 2011, when gold hit 1,900 and silver hit $49, geez, outside of maybe someone I recommended it to, I don't know. It's not like there were a ton of people in the U.S. going out buying physical gold and silver. So even when the price was moving, we didn't see that happen. And will be interesting to see what things look like when the public does get more fully involved one of these days. And perhaps last question before we wrap up here. For people in the public or otherwise who are watching this, maybe don't have the same level of insight that you do and are somewhat confused because we hear all this stuff from central banks, which maybe is wise to take with a grain of salt. Yet in the end, it seemed to me, even back a decade ago, that the Fed has kind of backed itself into a corner, maybe the Fed, all of these central banks, of which there really is no exit, because at this point, you can try and raise rates, but there's so much debt, so much bad credit out there that it probably would take out a lot of these banks, which in that type of scenario, I would say I'd still feel pretty comfortable with gold and silver. Or the alternative, which I think is more likely, is they just keep printing until there's nothing left to print anymore. Yet in either case would seemingly be a good environment to be holding metals, and hopefully something people could do and feel comfortable and sleep at night. Is that a reasonable assessment, or is there another way, or how do you see it all playing out?
Well, for me, gold is basically an option on aggressive monetary policies and the potential monetary endgame. We wrote more than 2,000 pages of research about the gold market. I'm doing that for 13 years now, publishing an annual report. And we came to the conclusion that gold is a terrific hedge and insurance policy in times of recessions, and a recession might be ahead, in times of rising inflation, in times of negative real interest rates, and of course a hedge against extreme monetary policies. Gold also does really well in times of turmoil in equity markets. So if you say, okay, one of those scenarios, one of those threats might be ahead, of course you should own some gold. From my point of view, gold will become a core asset for generalists again. Gold, basically, at the moment, it's not existent in the asset allocation of generalists. I think this is slowly but surely changing. And from my point of view, I mean, that's up to you if you hold 5, 10, 15, or 20% of gold, if you hold physical gold, or if you hold mining stocks. But I think not only from what I call safety gold or insurance gold, but also performance gold. So just betting on higher prices via mining stocks, for example, is pretty sensible at the moment. So I think it's just a good risk reward. As I mentioned at the beginning, price action is really positive. I'm a bit concerned about the commitment of traders report. Sentiment is still quite positive. So perhaps we might take a breather in the next couple of weeks. But in general, I think it's a fantastic environment for the price of gold. And this party has just started.
Yeah, and like you said, we good to keep in mind that we may have pauses and a little breather here and there. Although, again, President Trump calling for negative interest rates, QE, usually doesn't go too long without one of those comments. So keeps a bit in the market. And perhaps for folks that would like to get a copy of the report or some of the great research, or maybe interested in the fund, if you could just let them know how they can reach you and stay in touch with what you're doing.
Yeah, absolutely. Well, all information about us, about our products, about our services is on the webpage incrementum.li. LI stands for Liechtenstein. We're based in Liechtenstein, basically the center of Europe and one of the most stable jurisdictions that we found. So it's no coincidence that we're based there. You can subscribe to all our research products totally for free. We've got one website completely dedicated to the In Gold We Trust report. It's ingoldwetrust.report. You can download all editions of our reports, and you can also find me on Twitter. It's Ron-Peter Sto ferle, and yeah, I enjoy tweeting out interesting charts. I'm pretty active on Twitter, and I think it's a great source of information, but also for discussing market views with people from all over the world. So yeah, feel free to contact me, to have a look at our web pages, and yeah, perhaps we can do such an interview again.
Yeah, I'll look forward to that. We'll have those links in the description below so people can find you. And Ronnie, it's really a pleasure catching up. I've been following your research for quite a while now and appreciate the information you give out, because it's not the easiest time for folks if they're just watching CNBC. But it's nice that there are people like you out there that are putting good information out. So I will look forward to checking in with you again. And thanks so much for joining me today.
Thank you very much, Chris. It's been a pleasure. Thank you, and all the best to you and all of your listeners. Thank you.